Okay, so this is James Haft. How are you? Co-founder of Crypto Oracle with Lou Kerner. We're proud to be here hosting the securities token offering track at CIS. This panel is about the design of security tokens from a legal perspective. We're lucky to have here an excellent panel, and I want to also point out that we were successful in making our panel predominantly female to disprove, and I hope it becomes evident as you go through the tracks that we've really worked hard to have diversity on the panels, because we think that through diversity comes strength, and it's important to us. So I'm going to let everyone introduce themselves, and then we're going to talk about security token design from a legal perspective. Emma?
Okay, so we've done this before, but I'm the CEO and founder of the Satis Group. Through Corinthian Partners, we're a broker-dealer. We all hold our FINRA licenses, and what you're going to hear out of my mouth is tax, FINRA, broker check, going to jail. Roughly in that order.
And getting to yes. Yeah.
My name is Katia Fischer. I'm a partner with the law firm of Fischer Cagliati, based out of New York. We provide outside general corporate counsel to a number of projects within the blockchain space and have advised on various token offerings.
Hi, I'm Lily Tesler. I'm a partner with Sidley Austin and head of the FinTech and Blockchain group out of the New York office. I've spent a lot of my career working in traditional financial services, and the last several years have really focused on helping blockchain technology companies implement securities or non-security token offerings, as well as helping a lot of the secondary trading market structure for security tokens develop in this market.
Hi, I'm Jor. I'm just a dude that's unemployed, pretending to be an advisor in the space. Seriously though, I'm a ex-corporate securities attorney, and I've been helping build out the securities ecosystem from custody to identity to tokenization technology and exchange. So I've had the good fortune of working with a number of the prominent players in the space.
So let's start with Emma. I want to ask about, this has been a fast evolving market. We went from zero to where we are now, in less than a year. Can you talk about what is the history of security token? What's been happening over the last 12 months?
Sure. So while we were at Argonne, our licenses were with North Capital, we did 3 security token offerings last year, which was BCAP, which was the first, Science and Protos. And each was different in many ways, but they were all tokenized funds. And one of the things that drives me crazy is we've seen this year so many utility tokens trying to tokenize funds, and it just doesn't work. Because when you tokenize a fund, you're not just into the 33 and the 34 Act in terms of securities law, you're into the Investment Companies Act of 1940, which is a really, really big, scary piece of legislation. Really, really big, scary piece of legislation. So this year, we've seen a variety of security tokens get issued. They're usually done under 506C of Reg D, which is a phenomenal liberalization, which basically allows you to do everything that you would in a public offering, but it's still considered a private placement. And then Reg S allows you to sell into rest of world, but you also then need to comply with the local laws in those local jurisdictions. And what I'd say is it's still very new. When we run these deals, we work with tax lawyers and tax accountants to get the tax structure right, and then we allow the fund lawyers and the securities attorneys at it. But in many, many ways, very little has changed in terms of capital markets. Tax still rules, tax still has to win, then you can let the securities lawyers at it. And so while a lot of it's new, a lot of this hasn't gone through the SEC yet, we haven't seen the IRS give an opinion, there's a lot of uncertainty. The way we run it is pretty much how capital markets deals have always been run.
So, Lily, what is, from a regulatory perspective, what's changed, and what level of knowledge has changed that would put us in a better or worse position now than we were 12 months ago?
So there have been a lot of regulatory developments in the last 12 months, but two that I want to highlight. One is a lot of the regulatory guidance the industry's been waiting for coming out of the SEC, and there hasn't been a lot of clarity as to characterization of these token instruments, whether they are or aren't securities. So I actually participated a few weeks ago down in Washington on a blockchain roundtable hosted by Congressman Warren Davidson, who is proposing a bill later this year to Congress that will define potential characterizations of what tokens are. Well, the law currently, the securities laws define what are securities, but what tokens would potentially not be securities, and various characterizations of that front. It's very early stages, but that's a way that Congress is thinking about providing some guidance as opposed to waiting for the SEC on that front. The other development is a lot of the work that the secondary trading infrastructure in this space is developing to support security tokens. So I work with a lot of exchanges that are currently either registered as broker-dealers with FINRA and the SEC, or are looking to get registered to support trading of security tokens. Currently, there's only a handful, probably less than a handful of exchanges that are approved to trade digital assets that are securities. But something to watch in the coming months is more of these potential approvals and guidance from the SEC on the secondary transfers of these security tokens, especially those that Emma mentioned are issued under Reg D. There are restrictions on secondary transfers, at least for the initial first 12 months, but there could be some trading capabilities developed in private securities markets that allows for liquidity during those first 12 months. So that's something to watch out for as well.
And Jor, from a technical perspective, how has the change in the regulatory environment and the marketing environment forced changes in the designs of the tokens and where the intelligence sits in the network?
So, essentially you had the ICO market, and they all kind of were built off the ERC-20 standard. And kind of as people came through and realized that regulations do apply, and a lot of these are security tokens, you saw kind of two things happen, right? You saw a lot of people start doing the first move. You saw a lot of people start doing ICOs of ERC-20 tokens, but then they started adding AML KYC. And then after that, you started getting more sophisticated token designs where people would modify ERC-20 to add in, a hash to some sort of, subscription document or booklet or some stock legends to try to kind of mirror the real world of securities law a little bit better. And then also, you had this addition of a restriction. So someone would build into the token itself some sort of logic along the lines of transfer will fail unless on whitelist or something like that. And if you look at like Securitize and their DS protocol, if you look at Polymath, their ST20, if you look at I think Harbor, they all function that similar ways, right? So you ended up getting this proliferation of protocols, and then one day someone came out and said, okay, well, let's try to standardize those protocols, right? So they came up with the ERC 1400. And then shortly after that, now you have 1404, you've got 1450, you've got 1462. So everyone's trying to now rush to claim credit for the standard, which no one should really claim credit for, but everyone's doing it anyway. So hopefully one day, everyone will kind of pick out one standard, but I think the idea is they're trying to do tokens that give a little bit more control to the issuer or the transfer agent or someone, so that they know how these are getting exchanged. They can play within current regulatory frameworks. Some of the better designed ones are designed in a modular format, so they don't just work with US laws. They could work with any laws, any jurisdiction. But we haven't seen them in broad use just yet.
Interesting. And Katya, in working with clients, how has it changed over the last couple months, talking about security tokens and the paths to liquidity?
It's changed a lot. I would say that I was here at Crypto Invest Summit 6 months ago, actually watching you on stage. I remember it very, very well, and it was a completely different atmosphere in the room. I think that there was still a lot of discussion about utility tokens and trying to argue with the SEC and getting legal memorandums and the like, and the attitude has changed, the atmosphere has changed, the crowd has changed, and it's been really, really interesting just to see that over the last 6 months.
So,
Emma, when you have a new client come in the door and they have their idea, but they don't really they haven't looked at the tokenization structure and they haven't looked at how they're going to interface with this changing sets of laws, how do you advise them? What's the first thing to think about?
and we were talking about this outside. Lots of things are new about security tokens, and they offer flexibility to do extraordinary things, and particularly, tokenizing funds allows you to take something that's historically illiquid and at least provide some liquidity along with other advantages that you can do. And the way that we always describe ourselves, we all come from a coding background one way or another, but the way that we describe ourselves is just 95% cap markets. We've got some people from a banking background, some people, I predominantly come from a legal background. And so when we sit clients down, it's first, kind of scoping out what they're trying to do, but one of the things that we encourage them to think about is to produce something that's financially a better mousetrap. We generally think that family offices and high net worth individuals, who are the main market at the moment, are actually smart people. And if they can get it currently in the public markets, well, they're going to do that. And if you're producing something that's currently available in the public markets, well, they're going to go and buy something that's much, much more simple to custody and control and deal with and so on. So, the first thing that the bankers do is work to build a better mousetrap with that client, however it's done, however the structuring is done. And I'm just going to kind of annoy James a little bit by saying, you cannot sit down with a client to discuss structuring a capital markets offering, just even discussing whether they're going to go the security token route, unless you have a FINRA Series 79 in the room. And FINRA has just simplified their exams, but it's a 5-hour exam. It's a 5-hour exam. You don't just sit down and take it. And what's more, if you don't come from a capital markets background, slapping a 79 on a failed accountant doesn't make that failed accountant a banker. And there is an awful lot of advisory shops in the space who don't get that. That person also has to have a Series 63, which is a state marketing exam, and then to actually walk the product out, they have to have the FINRA Series 7, which is another 5-hour exam. And, this stuff is super serious. We are going to progressively see enforcement. I think what the SEC and FINRA would say is that they're encouraging people to come into enforcement. But, you're going to see them beginning to drop the hammer. So we kick the tires, we help the client build a better mousetrap, and then we kind of run it through the tax accountants and the tax lawyers, make sure that we think it's going to work from that level, and then we take it to securities and commodities attorneys and walk it through that and just kick the tires, make sure that overall our better mousetrap's going to work from a legal and tax perspective. And then we go back to the bankers and build out that mousetrap and figure out exactly what it's going to look like, what it's going to do, what benefits it's going to give, and then we walk it back to the tax accountants and the tax lawyers, and we bake it with them. And once it's baked with them, then we let the securities lawyers at it, and we build out the PPM from there.
Lily, coming from a large law firm perspective, when the next tokenized deal walks in the door, what are the concerns that the law firm has about representing the tokenized transaction, and what are the things that prohibit you from getting to yes with clients as a rule?
Some of the things that we evaluate in working with projects is, do they understand the legal and regulatory hurdles to get them over the line for the securities offering as well as for the implementation of the blockchain itself. One of the things we ask is, do you need a token? Why do you need a token? And can that token function as a security token on that blockchain after the initial sale? Because it's easy to structure, not easy, but you can structure a compliant securities offering to raise funds, but getting that security token to function on a blockchain, if it's not an asset such as a fund structure that's really just an investment vehicle, is also a burden that needs to be overcome by that project. So it's making sure they fully understand the entire legal and regulatory path forward before we start working with them.
And Jor, how does all this affect the company, the issuer themselves, and the opportunity for secondary trading?
Well, I think it's a lot of work, for them to kind of go through it in a new industry. I think that sometimes, there's a lot of, there's this discussion about STOs, and STOs are sometimes, ICOs that are, just sold like securities offerings, and then sometimes they're, actually it's just a securities offering, but then they've just tokenized it because they want to take advantage of technology. So there's a little bit of confusion, I think, when people use the same processes to describe those two types of deals. But traditionally, I think when issuers come in, the most important thing is just get good help, and then understand. What I tend to focus on primarily is kind of the gaps that exist between kind of the legal and business practicalities, and then what the tech can or can't do, or the current state of it. So it's really easy for the lawyer to say, oh, you're doing Reg D, you can't transfer this within the 12-month period, but you might be able to if you use this exemption, and you might be able to go out of state if you, out of country if you use this exemption. Oh, by the way, you can't do 2,000, can't do more than 2,000 because you're this type of securities. But most of the lawyers aren't having that discussion with the developers, and then they're talking to their issuers. The issuers aren't having that discussion with their developers. So what you end up having is a smart contract that doesn't necessarily control the offering and manage the offering afterward at a cap table all the way through listing, so that it stays compliant. So you've had folks that have issued out, probably legally, the initial issuance was fine, but they didn't manage their tokens weren't designed properly, they didn't manage it properly, and now they're having trouble getting listed on a legitimate securities exchange because the securities exchange are afraid to touch them because they've got tainted securities. So those are the type of things that I tend to focus more of my time on to try to kind of narrow that gap a little bit.
My belief is it's not a fun panel unless you have some disagreement, and we have two people who want to take opposite sides of the Reg A Plus discussion. So first, Katja, can you talk about Reg A Plus and why it's important and why it represents opportunity?
Sure, absolutely. So I don't know if I've formalized a final definitive opinion on Reg A+, and this is just a discussion that Emma and I started having before we came up on stage, and we were having so much fun that we decided to share it with all of you. Big question that I have in my mind about Reg A+ is that as attorneys in the space, this has become something that has become commonly discussed as sort of the next stage in security token offerings. You want to go ahead, you want to open this up to non-accredited investors, you want to crowdfund Reg A+, fantastic idea, it's like a mini IPO, it's expensive, but it's not too expensive, it only takes a few months, so on and so forth. The only issue is that there isn't a single project that's actually been approved for Reg A+. So my big question has been, while taking a look at this, that despite all the discussion around this, despite all of the excitement about the idea that Reg A+ might be the perfect solution, what is it? How are we going to see this pan out? Is the SEC actually going to approve some of these filings? And if the SEC does, which projects is it going to approve and why? And so I started asking this question backstage, and we got some interesting thoughts.
And so the funny thing is we don't disagree at all. But, we potentially have a controversial view. So just to be dorky and explain to you what we're talking about, when you do a private placement, a Reg D offering, you don't need the approval of the SEC. You don't file anything with the SEC until you've sold, but by the way, your lawyers need to tell you that within 15 days of closing, you have to file a Form D And you need CIK codes to do that, and then you need to file in every single state you've sold into. And by the way, everyone always assumes, and every lawyer who annoys me does this, and says, oh, we're only going to sell into California, Florida, and New York. Where else are people buying security tokens? Well, I can tell you, in about 20 bloody states. And getting the Reg D filings is not amusing. And so, anyway. Reg CF and Reg A Plus are radically different. So Reg CF is reg crowdfunding. That allows you to sell to non-accredited investors, whereas the quid pro quo with 506E of Reg D is that you must only sell to accredited investors in the US. Reg CF doesn't require any checks at all, and you don't actually have to file. But the kicker about Reg CF is that at the moment it's capped out at 1.7 million. There were lots of legislative efforts last year to get that raised. There are legislative efforts this year, but kind of that's the Reg CF is the future, and then the democratization of finance. But like it's not there yet because of the size. Reg A Plus allows you to sell to non-accredited investors. Those people have to certify that they're not investing more than 10% of their net wealth, but you're good. And the amazing thing about Reg A Plus is that it immediately trades. So you don't have this 144 Reg D 12-month holding period, compliance, other issues. It immediately trades. What's more, you're never into 12G. If Reg A Plus effectively takes the company public, but you're never, 12G requires you to file an S1 when you go over 2,000 investors, more than 500 of whom are unaccredited. And Reg A Plus pulls you out of that obligation. The kicker about Reg A Plus is that you do have to file a form with the SEC. The SEC does have to go through a comment process with you, and they do have to sign off. And this is the problem, which is, there's almost no practitioner who's ever got a Reg A Plus offering approved. There's maybe been, I don't know.
I think it's about 100?
Max.
Maximum. I mean, the thing about Reg A Plus is that it's fairly new across the board. I mean, taking security tokens out of the equation, Reg A Plus is something that companies have only had the opportunity to use in the last couple of years.
3 years, so it was a Jobs Act liberalization along.
Yeah, so to my knowledge, none of them have been approved for blockchain usage yet, which frankly is probably the SEC's fault. Outside of the blockchain space, they have been approving them. These things have been used in crowdfunding. People have used Reg A Plus and then gone out afterward and tried to establish a secondary market trading on OTC, BB, et cetera. So they do get approved for sometimes some really crappy companies that are really horrible, but they do actually get approved. The issue, of course, is that Reg CF and Reg A Plus, the market kind of has, long before there was blockchain, there was crowdfunding, and the market kind of valued the options and said, well, am I going to use CF? Am I going to use A? Am I going to use D? And clearly, 506C and 506B win by a landslide. So they're kind of burdensome to use, but they are options. Just in the blockchain space, I think Reg A Plus is, we're waiting for the SEC to get a handle on it and start approving them.
So my favorite quote about Reg A Plus, and the person's going to remain nameless, but that the SEC designed it to be so horrible that no one uses it. But it's not necessarily wrong. And one of the things that we've seen, which is very troubling, is that every time a client even thinks about doing Reg A Plus, the lawyers immediately start pushing them to produce what is equivalent of an S1. And that's the point at which we go, hang on a minute, like if we're going down this path, then let's just file the bloody S1. Reg A Plus is supposed to be a 6-page form. I've never seen a Reg A Plus PPM, private placement it's offering memorandum, that was shorter than 100 pages. And we've gone through this with several racks of attorneys who've tried to even make Reg D offering memorandums like 200 pages long. And that's the point at which I'm like, oh, bullshit, let's just file the S1 and be done with it. And that's the problem. And there is allegedly somewhere between, I've heard everything from 20 to over 100 security token offerings in Reg A Plus backed up with the SEC. And when kind of we get a little bit critical about the SEC here, it is like, hang on a minute, you're going to have to actually approve one of these things. And you know, does someone else want to comment on how this is going?
So I just wanted to add, and I think this is not just for Reg A offerings, but there's a lot of registered offerings pending before the SEC. So some Reg A offerings, I know of S1 and F1s that are before the SEC related digital security tokens, and they're also recently rejected and have a stay on the Bitcoin ETF futures as well. And one of the SEC's concerns is that there's not a developed secondary marketplace for trading these security tokens. So and I'm not saying that's the reason they're not approving some of these, but it's one of their many concerns, is that investors will not be sophisticated enough to trade these tokens yet, and there's not the secondary trading infrastructure. There are a couple alternative trading systems currently approved to trade security tokens, but there's no New York Stock Exchange or NASDAQ or any other established markets. And there's also not a good qualified custodian solution for the institutional marketplace to trade these security tokens. So in order for registered investment advisors to hold any tokens that are security tokens in custody, there needs to be a qualified custodian, which may be a bank or a broker-dealer approved by the SEC or the bank regulators to engage in this activity. So until all of that is worked out, I think it'll be one of the things on the SEC's mind in approving these new registered offerings.
So I think that this and another thing that we were talking about backstage is really interesting, because right now as attorneys, we're in a very strange spot where the best we can do is sort of take a look at how the market is currently and make predictions for the future. But we don't have final answers. I mean, everything is so prospective right now, right? There are so many things that we're looking at. So another issue that we were taking a look at, beyond taking a look at Reg A Plus and how the SEC is going to be looking at this market, also is with regard to taxation and the tax structuring of tokens, how they will be looked at, how the IRS is actually going to go ahead and take a look at these offerings, particularly when you take a look at, for example, securities token offerings that offer very little equity-like rights, and how that's going to be treated and how that's going to be dealt with. So it's an interesting time.
Just very quickly, the big scary, if you're a security token issuer, the big scary three-letter agency in your life, it's not the FBI, the DOJ, it's the IRS. It is the IRS. And what we're talking about is 1032 of the IRS code. No one's actually solved this, by the way, for debt. Anyone tells you your debt security token offering is going to work, well, I've yet to see a tax accountant or tax lawyer who says it does. So we're trying to put it under 1032. 1032 allows your capital raise to come in tax-free, but it's only available for equity offerings. So this is the nuts and bolts that we're getting at. Underneath this is, I used to say I used to line up with the SEC and say we don't need new legislation for security tokens. We've got great legislation that's built. One of the most successful cap market in the world is the United States. But I am now very much differently of the view, and I think we need above all, not just securities legislation, we need tax legislation for security tokens.
All right, so we're out of time, but I'm going to ask a one-word answer from each panelist. Okay, assuming that security tokens are the thing, and this is where the liquidity is going to come from, how long do we have to wait before this becomes an organized, normalized market? A number of years or months.
Light question. In terms of the market, in terms of the appetite amongst investors, it's now. Like, the level of interest that has peaked in the last quarter is huge. When are we going to see active trading, deep liquidity, custody and control, qualified custodian? Somewhere between 3 and 12 months, and that somewhere is.
That's not what you told me.
I don't have a crystal ball, so.
One word answer. We're out of time. So one.
2 years.
All right. Good.
12 to 18 months.
I heard you say a lot of things, but in my mind, you just said Ren Moon. No, to get to what you described, I think like a decade. but I think custody and all that stuff that already exists today. There's a bunch of qualified custodians.
All right, guys, thank you so much. I really appreciate it.